when you're buying options, there are two basic types you can buy. Let's get a little bit of the terminology down that's unique to options themselves. First of all, there's what's called a call. And as you can see by the picture, a call is basically what you would normally buy if you think the price will go up. Okay? Just like the man's megaphone is aiming up in the picture. Okay? A call is a specific kind of contract that lets you execute the trade at a higher price. So naturally, you would want to exercise that option if price moves up. Okay? Call up. The opposite of a call is called a put. And for this, I use the example of putting something down on the ground. Okay? In other words, you would buy a put. You're still buying a contract, but you buy a put if you expect the price to go down because you're going to exercise the contract at a lower price than what you bought it at. Okay? Call up, put down. See, it's not that complicated. Anybody confused yet? Or are we all on the same page? Buy a call if you think price will go up. Put it down if you think price will go down. A lot of institutions that use options for stocks use them for insurance. And you can do exactly the same thing with forex trading. You can combine what you know from both worlds, forex and options, but let me show you how to use them for insurance instead of speculation. Okay? You'll recall our prior example. We buy calls when we think the price is going to go up. Okay? Well, those of you that have known me for some time, you know that I'm a contrarian. I like to do things differently. So for insurance purposes, we're going to buy a call if we think price is going to go down. The opposite of the picture. Now, you might be scratching your head going, what the heck? I thought you just said buy calls when you think price is going to go up. For speculation, yes. For insurance, you do the opposite. If you think price is going to go up, if you think price is going to go down, you buy a call. The exact opposite. And let me show you why. Let me show you how this works. You're going to love it. Okay? Let's say price has been chopping for a little while in a range. You're not quite sure what it's going to do next. And suddenly price makes a sharp down move and breaks out of the prior range. Okay? This would cause you to believe that price is going to go down. Right? It broke the prior range, made a lower low. If you think price is going to go down, you open a short trade. Right? You sell. But at the same time, for insurance purposes, you'll simultaneously buy a call, which is a bet that price will go up. Let me show you how this plays out. Assuming you went short and price does continue moving down, well, you're a happy person. Because the short trade you took in spot FX is now in profit. And you just made money. What about the call option that you bought? Right? That was a bet that price would go up. And that contract expires useless because price never went up. It went down. But the cost of an options contract is a few bucks. Meanwhile, hopefully you made much more than that in profit on your short trade. So in other words, you bought an insurance policy. You didn't have to use it. Thank goodness. Right? Insurance is never free, but you're glad you have it when you need it. Okay, so you lose the money on the options contract, which is usually a few bucks, but you've made much more of that in profit on your real trade. Now, let's take a look and see what would have happened if price went the other way. It broke out of the bottom, but we didn't wait for a retest, or for whatever reason a new piece of news comes out, price does the exact opposite of what we would have expected, and it goes up. Well, in that situation, your short trade is in the negative, right? You expected price to come down here. Your short trade is now losing money. But you have an option that you can exercise when price gets up here, and that option is in profit. Now you start to see why the banks never lose. they've got their butts covered. Either way, they're going to make a profit. If the trade does what they expect, they make a profit on the spot trade. If the trade does what they didn't expect, the money they make on their option brings their loss to break even. And that is the value of an insurance policy. You guys starting to see the wisdom of this? We're not saying drop what you've been doing in forex and switch to options. We're saying add options as an insurance policy on your forex trade in case they go wrong. Okay, now obviously if you're a scalper on the 1 minute, 5 minute chart, this will be of limited use to you, because the cost of the options contracts added with your spread on the spot trade is usually going to make this not very worthwhile. But I try to discourage people from scalping and short-term trading anyway. It's a great way to lose. There's lots of noise in the markets. But if you're taking longer-term trades, adding FX options to your repertoire is very quickly going to become one of your best friends. Oh, you use stops as well, Boyke, because you don't want the losing trade to go too far in the opposite direction, and your stop should never be wider than your option is. Usually your stop will be much tighter, and that's why the option can often earn you more money than the losing trade loses, because it's probably not going to go all the way up here. Your stop would probably be triggered outside and above the range. Meanwhile, your profitable option goes all the way up to here. Okay? So oftentimes, your option will bring you more profit than you lose on the trade if you use stops. It's about using these things in combination. All right, now let's take a look at an example with a put and how that would work. Okay? If you'll recall, I said buy puts. If you're a speculator, you normally buy a put if you think the price will go down. Well, me being the contrarian, I don't like that rule. We're using options as insurance, not as speculation. So we're going to buy a put if all our analysis leads us to believe that price is going to go up. Then you buy a put. We do it the opposite way. Okay? Here's our price bouncing in its range again. Oops, we just made a higher high. This leads me to believe price might go higher. So I'm going to open a long trade, I'm going to buy the currency pair, and simultaneously I'm going to buy a put as an insurance, as a bet that it'll go down. Remember, you don't have to exercise the contract. You have an option whether to exercise the contract or not. Well, let's see what would happen, how this plays out. Okay? If price goes up and you bought long, you're celebrating because your long trade is in profit. Meanwhile, your option contract down here expires worthless. But again, the option contract costs you a couple bucks. Hopefully in profit, you've made much more than that. Insurance is never free if you want it. Okay? Let's look and see what happens when the unexpected happens. We break to the top side of the range, and suddenly there's a sudden downside reversal. Price does the complete opposite of what we expected. Okay? Well, now the long trade is in the negative. It's losing money. However, you've got the option to exercise your put at a lower price. So that would lead to profit. Worst case scenario, break even. But if you combine this with stops, perhaps right below the bottom of the range, the option has more profit than you lost on the losing long trade if price goes down. In other words, this is a true hedge in its truest form. A lot of people toss the term hedging around without really understanding what it means. Everybody understand the long and short of this? Whatever trade you're taking, you take out an option in the opposite direction. The theory being either your trade or the option will be profitable, but you will never have two losers. That's what makes it a hedge. You buy the option in the opposite direction of the actual spot trade.